how this came about and why we're having a book event at MBA. My book was just published on September the 30th, so it's just published, and we knew about this timing last summer, and that's how the event came about. And I really appreciate the sponsorship. The story of the financial crisis is, at its core, the story of mortgage banking. I have had an opportunity to know and analyze this industry since 1988, when I first began writing about it for Mortgage Banking magazine. From the first day, I found mortgage banking to be a fascinating, tough, dynamic industry where companies can be wiped out in the blink of an eye, and where mortgage bankers sometimes have to be as vigilant and focused as fighter pilots in order to navigate the challenges they face. It has often been the case that mortgage bankers who take their eyes off the ball are dealt a swift and ruthless judgment by competitors and the markets. I was intrigued by the fact that markets were so brutal and swift. Free markets corrected and regulated the business. Mortgage bankers have been able to double their origination capacity in short order or cut it in half in short order. Barrier to entry have been low, and no one can long rest on one's laurels or be smug. Mortgage servicing rights can be wiped out in an instant. Hedging those assets can be tricky and also lead to big losses if done wrong. The markets ruled with a vengeance. It was not just Adam Smith's famous invisible hand at work. It was more like an invisible fist. It was my first year on the mortgage beat in 1988 that I met and profiled Angelo Mazzillo, co-founder of Countrywide, in a story titled, That's Angelo. Years later, he said to me, in reference to that story, "You made me famous." When I chuckled at the likelihood that that might have been true, he assured me, "Oh no, I mean that." To interview Angelo, I went to Pasadena, California, then the headquarters for Countrywide. At 47, he was already known for his perpetual tan. He had a modest office in a modest office building. I expected the interview to last an hour, perhaps an hour and a half at most. Fat chance. Angelo was eager to talk about the history of the company and his own life story, and the interview ran to 7 hours, requiring a number of breaks, the longest interview I've ever conducted. We wandered into many directions that might seem to some like pointless digressions. Mazzillo was an avid collector of Hudson River School landscape paintings, and I got a tour of the collection, already considerable, hanging in the hallways of his corporate offices, and heard some of the stories on the acquisition of key paintings. Mazzillo was the epitome of the dynamic mortgage market, and Countrywide became the pace-setter and leader of the industry and its public face at the time of the crisis. From businessman to passionate advocate for lending to low-income and minority households, Mazzillo had the personality and charisma that suited the industry. By 2009, however, Angelo had become the chief villain of the financial crisis on the front page of the New York Times. In the end, the market strengths of mortgage banking eroded and it became an engine of bad credits. By 2008, the mortgage industry, both agency and non-agency, had created nearly $5 trillion in bad credits. Nearly half of them hidden away in black boxes at Fannie Mae and Freddie Mac, and thus not fully known to the market. Others were hidden in black boxes on and off the balance sheets of banks. These bad credits are at the root of the financial crisis, but do not entirely explain why it happened. While I was fascinated by the efficiencies of the mortgage market, I also reported on the clouds that began to gather on the horizon. Subprime 2 decades ago was a vastly different market from what it became during the bubble. Early subprime loans charged a big premium to cover potential losses, and even then the losses could devastate the lender It was not vigilant about underwriting. The market was A-minus paper mostly, and there had to be significant down payments. Not the B-C market it became with little or no down payments. Then in 1992, a new era took hold in Washington when it became official government policy to push down lending standards to expand home ownership to lower income and minority households. Over the years, as lending standards fell lower, origination volumes rose higher, and subprime and other risky loans took a steadily larger share, again under policies imposed or incentivized or pushed from Washington. In 1993, I first warned that trying to achieve equal outcomes for people with good credit and a good down payment and people with bad credit and little or no down payment was destined to cause grief and serious financial harm. In 1995, Fannie and Freddie ventured into 3% down payments, and it seemed to work okay at first. In 2000, I reported on the dangers of 100% loan-to-value lending, then being ushered in by Fannie and Freddie. By 2004, I was writing about the rising dangers of interest-only and no-income, no-asset lending. By this point, the government-sponsored enterprises were getting so large that Fed Chairman Alan Greenspan worried about how a failure of one would pose systemic risk. I wrote about that too. Then I wrote about the rise of private label mortgage-backed securities, which became the dominant part of the securitization market in 2005 and 2006, propelled by subprime and all-day lending. But then by then, the clouds had formed into a perfect storm. But even with my deep knowledge of the industry and anticipation of a bad outcome, I was surprised in 2007 at the severity of the mortgage meltdown and its global fallout. Starting in January 2007 with subprime lenders, the mortgage implosion took out nearly every major lender, and Countrywide survived only with an investment of $2 billion by Bank of America. The subprime collateralized debt obligation, or CDO market, collapsed by August. The entire edifice of asset-backed securitization also came crashing down. The collapsing financial infrastructure began to expose the hidden dangers that had been lurking, unseen, and unknown. Carefully crafted efforts by banks and investment banks to hide subprime exposures on and off balance sheets and black boxes began to unravel. A run began on structured investment vehicles, or SIVs, holding mortgage assets, including the notorious super senior tranches of subprime CDOs. Hundreds of billions in financing for SIVs from asset-backed commercial paper failed to roll over as money was drained from the system. On trading desks out of the public sight and from the eyes of the ever-vigilant markets, traders began to impose haircuts on repurchase or repo lending tied to securitizations. A financial panic was underway, but no one could see it. The repo run of 2007 would eventually do a second and larger run in 2008 and amount to perhaps as much as $1 trillion drained from the banking system. And at the time, no one realized that much money had been pulled out. I wrote about the mortgage meltdown in an October 2007 article for Mortgage Banking. Researching that story gave me my first examination of the frailty of the shadow banking system, in which mortgages played the starring role. That article was cited more than a year later in November 2008 by Wall Street Journal columnist Daniel Henninger in a column titled Mad Max and the Meltdown. Watching and reporting in depth on the severe impact of the mortgage meltdown made me intensely curious. How did so much bad lending accumulate outside the purview of the markets and the regulators? Why did it spread and threaten the entire financial system? As I followed the global financial credit freeze that ensued in the aftermath of the failure of Lehman Brothers, I was again astounded that so much financial carnage had come from bad mortgages and a vulnerable shadow banking system. The damage far exceeded the value of bad mortgage assets. I wanted to understand what made the financial system so vulnerable to large, hidden, bad credits. I wanted to know the answers, and I wanted to write a book about what I found so I could share what I learned with the world. That's when I decided I must write a book. My quest to understand the causes of the crisis became a passion and an obsession, as often is the case for authors. You need that passion to keep you going through the tough challenge of doing the book. I saw this as a monumental mystery that needed to be investigated and explained. And as I began to research the book, the challenge turned out to be far more daunting than I ever expected. Not surprisingly, people central to the story did not want to talk. I learned that the fastest way to a dial tone was to call a Wall Street firm and ask to talk about subprime CDOs. Since much of the risk posed to the system had been created in black boxes, it was difficult to see into those boxes even after the fact. In the end, the entire mortgage market failed. The largest financial market in the world in 2008 at $11 trillion. Following the government takeover of Fannie and Freddie in September, it finally became possible to obtain the kind of detailed information about risky lending and investing that was occurring in these two institutions that are central to the story of the financial crisis, and which turned out to be the biggest black boxes of all. Progress in gathering helpful information, revelations, and insightful commentary was painfully slow. As I trudged through more than 100 interviews, mounds of information uncovered by others, including interviews, testimony, and documents from the Financial Crisis Inquiry Commission, I pieced together the story of the crisis. Slowly, I found the broad framework of the story and was able to identify the major forces that converged to create the opportunity for a crisis and identify the events that triggered it. I was able to find people to help me tell what is in fact a very dramatic story of financial wreckage on an epic scale. To even describe the level of destruction that occurred is itself a helpful exercise, given that those details were often hard to come by and occurred out of the public eye. Black Box Casino is a story about the one half of the world of banking that is shadow banking. It is the story of how huge swaths of that shadow banking and financial activity moved into black boxes, where outside eyes could not see what risks were being created and how multi-billion-dollar bets were being placed that markets would fail and reap the speculators' unprecedented fortunes. Nor could people understand the level of fraud that was being concocted in some of those black boxes. We would later learn that major institutions like Lehman Brothers filed public disclosures that hid massive manipulation of accounting to camouflage sky-high leverage. In theory, securitization was supposed to spread risk and thus make the financial system more safe and sound. In practice, it was a different story, at least in the case of riskier mortgages. Instead of spreading small pieces of risk around the globe through the use of naked credit default swaps, risks were magnified many times and then spread around the world, creating a greater risk that would have existed if the loans had never been securitized and bets not placed against them. And in the case of subprime CDO business, securitization concentrated risk on the balance sheets of banks deeply involved in that business. Banks that put those risks in black boxes on and off the balance sheet. In retrospect, accounting for some of these players became a shell game of hide the toxic assets. The financial system had become more sophisticated and opaque and vastly more vulnerable. The mortgage meltdown exposed the fragile and faulty architecture of that system. In the aftermath of the biggest financial crisis of modern times, the American taxpayer and the global economy continue to pay a heavy price, and the tally for the final toll is yet to be made. If we to address the weaknesses in the system, we need to understand what went wrong first. Washington has failed to do that. I hope my book will be one small contribution to that effort, and I look forward to many more books from other authors to continue that effort. The American people, indeed the people of the world, deserve some honest answers. Thank you.
Robert would be happy to answer any questions. If anybody has any questions, if not, he's available to chat with one-on-one.
I have a question. In the book, what in the experience of the process of writing, what did you find was the most surprising? I mean, there was a lot, I imagine, there, but what was the most that was kind of the breathtaking? Wow.
Well, to me, there were two things. One was the level of risky assets that had been created and that were hidden from sight, that weren't known to be subprime, and those, were at Fannie and Freddie. And it was the work of Ed Pinto that really uncovered all those and identified those with the information that became public after they were taken over. And he devoted much of his time to that for over a year and wrote a number of papers. And then four economists from the Stern School of New York University did a similar exercise and came up with similar numbers. So the Fannie and Freddie were saying they had no subprime, if you can imagine. I mean, we look back and they were saying, no, we don't have any subprime. But they were not identifying subprime loans that were subprime if the originator didn't identify them as such, and often they didn't. So they went back through and looked at the loan characteristics, FICO scores, the loan to value, the lack of documentation, all of those things to reclassify those loans. And that was the first thing. The other was how the CDO market poisoned the private label mortgage-backed securities. I mean, it was a sort of a gut instinct that something had gone terribly wrong on the private label side too. But I couldn't understand the motive. What were the incentives? What drove this process? Because the mortgage industry, as I talked about, was so efficient and responded so well to market signals, and expanded, contracted. It was a perfect example of a performing market. But what happened was, of course, and even in this case, Fannie and Freddie were buying up private label mortgage-backed securities, and they were pouring huge sums of money into it, causing it to grow more than it would have, and giving a signal that it was a legitimate investment. But other people, as they do, found that they could make a lot of money putting together CDOs which they could bet against, and practically no one realized that's what they were doing. If you remember reading the chapter on AIG, they were having this discussion in these emails about the hedge funds that were investing in these, and they were wondering if, in fact, they were actually choosing assets to put in these CDOs, that the CDOs, they weren't putting together good CDOs, as it turned out they were putting together bad CDOs, as we know now. But it wasn't public information at the time, and we did not know they were making massive bets against the subprime. So a lot of money could be made from this, and because of the demand from these hedge funds for the lower tranches of the subprime mortgages, bonds, the CDOs could be created. Fannie and Freddie would buy the AAA parts, and the hedge funds, and they would bet against the lower rate tranches. So it increased the amount of funding going into the market that was looking for bad loans. So I mean, I knew that was going on one level, but I didn't understand how it worked. So I think figuring out how it worked was a real challenge, and I think I finally did. So yes.
So I'm curious what your take is on the rating agencies, because I haven't read the book.
Okay, well that's an important part of the story, because none of what I just described could have occurred without the rating agencies. And one of the things I found in researching the book is at the time, and it was in 1999 that the basic framework for another round of Basel was occurring, and the Banking Committee of the Basel Committee for Banking Supervision put out a paper, concept paper about how Basel II should be organized. And they came up with the concept of risk-adjusted capital standards. And in that concept paper, they suggested that the credit rating agencies play a role in determining capital standards, because the risk-weighted part of the would be determined by the credit rating. And in the book, you'll read where I think it was Moody's wrote a comment letter at the time to the Basel Committee and said, this is a terrible idea. People will, the whole process will be corrupted. It will lead to a terrible outcome. You shouldn't do this. Moody's actually wrote that letter in 1999, and it turned out to be 100% correct. They went ahead, of course, they adopted it, and because now the decision on what would be rated A, AAA, B, and how the deal was structured, all of that was going to be decided by what the credit rating agency gave the deal. That determined how much capital had to be held against it. So that was a big factor. And if the credit rating agencies had not been given that assignment, I don't think the whole CDO part of the story would have occurred. That's how important it is.